Hello, my name is Andrew Screen and I'm the Managing Director of Resi Capital Management and Trade Risks. I have a background in banking, property development and structured finance, and today I'm going to be speaking about the key issues and problems in funding property development. One of the key things I should mention before I start is that financing is about a language. It's about understanding a language and what that language means and interpreting what other people are talking about when they talk about the language. Just to give you a little bit of background about our business, Resi Capital Management is the fund manager for our REIT, or Real Estate Investment Trust, called Residential Secure Income PLC, which invests in alternative residential use class, both development and standing investment. We also have another company called Trade Risks, which is a brokering business which arranges debt funding, equity, and also issues bonds and REITs. On the slide here, I'm going to just take you through the capital stack. And the capital stack is effectively how you fund your development. In other words, what proportion you're going to use as debt, equity, and mezzanine finance. Now, the debt funding is typically about 60%, 50 to 60% during the construction period, and your equity funding would typically be around 20%. The piece between these is called mezzanine funding. Now, it's also called things like junior debt, B notes, or preference shares. And the important thing is that it sits between your equity and your debt. You don't always need it. If you have enough equity, then obviously you'll just have an equity slice and a senior debt slice, or you'll try and maximize out your debt slice by using something called stretch or stretch debt, which is really combining the two between your sort of senior debt and your mezzanine debt. I'm just going to pull up a couple of arrows here. You'll see the kind of increasing risk and return. And we basically move from, as you go up from senior debt to equity, you'll see that you increase your risk. So the equity has the highest risk, but also has the highest return. You also see on the security side that the highest security is offered to the bank. In other words, the bank gets paid back first under the senior debt, then the mezzanine finance, and then the equity finance is repaid back last. In terms of who funds and where they fund during that development cycle, this is a development type of timeline with the planning permission, practical completion, stabilization, and long-term funding, and the respective returns on the other side of the slide. And you'll see on the long-term side, they are typically pension funds, annuity funds, insurance funds, and things like the REIT, like ourselves, and endowment funds. In the kind of medium-term funding, in other words, somewhere up to about 4 to 5 years, you'll find the private equity, opportunistic funds, and venture capital funds. That's the typical area where they like to fund because they get a high return, but also because it's not long-term funding. And then we have the developers or landowners who obviously buy the site, and they will normally exit round about sort of that practical completion point. In terms of who's investing into the market, here's a selection of investors. This is by no means comprehensive. This is probably about 10% of the actual market. And what's important to understand about those kind of investors is there are different kind of durations of investment, so long and short-term investment funders. You'll also find that individuals and private persons generally invest under £1 million. Syndications are basically between 0 and 5 million. And then the private equity is somewhere between 5 and 25 million pounds. The institutional, annuity, and pension funds are generally between 25 and 100 million pounds. And then the sovereign wealth funds are usually a lot larger than 100 million pounds. Just coming on to the debt funding now. In terms of debt funding or bridging or mezzanine finance, before the crash, we pretty much only had the clearing banks, in other words, your kind of high street banks. But after the crash in 2008, it became much more difficult for banks to lend money, particularly on development, because of Basel III and slotting, which means that banks had to hold a lot more reserves requirements for their funding. And that's when we saw the alternative or challenger banks come into being. Particularly, these were private equity or venture capital funds, and they provided senior funding as well as mezzanine and bridging finance, particularly into the property development sector. We've obviously seen more of those clearing or traditional banks coming back into the market in the recent years. The important thing to understand about the debt funding or bridging or finance, is that there are three kind of general lengths of funding, and that's roughly about 2 years to 5 years, 12 to 15 years, and 25 to 50 years, depending on who you actually source the funding from. There's also different types of debt funding, as I mentioned: senior debt, junior debt, mezzanine, and bridging. And then you will also hear terminology like interest rates or coupons, and that's generally the combined rate of a base rate, which is either gilt, a LIBOR, or a bank's base rate with a margin added to it. You'll also hear about derivatives, swaps, options, forwards, futures, and those kind of exotics, as well as terms like fixed rate funding, variable or index linked funding. What we've also seen emerging after the crash was peer-to-peer lending. In other words, this is where one person lends to another person, in other words, doesn't go through a bank. And then you would have heard about crowdfunding as well, and this is effectively raising funding through the internet. Although it's less popular for development projects, it certainly is for standing investments. In terms of debt funding terms, these are the terms that you'll get from a bank if you go and apply for some funding. You will hear about sort of loan to cost, and don't forget that's the same as our capital stack in the first slide. In other words, that 50%, 60% debt funding, that's your typical loan to cost, or whether you'll get a loan to value. You'll also hear about stretch funding. Margins are where the bank's basically taking their margin above the base rate, and the term is obviously the length or duration of the funding. Arrangement fees is the fee for arranging the funding that the bank will charge, and the commitment fees are commitment fee charged by the bank, not always charged, I might add. Non-utilization fees are fees charged for not utilizing the funds provided or made available to you by the bank. And then there's obviously exit fees. If you decide to exit, there may be an exit fee. Also, there's a refinancing fee or penalty if you decide to terminate the loan or go with a different funder halfway through the funding term. So I hope that's given you a sort of idea. You'll also hear about things like interest cover ratios from banks and things like floating and fixed charges. What's important to understand is that while it all sounds very confusing and complicated, first of all, it's probably best to get a professional advisor to advise you, because there's a lot of different types of bank funding out there, or debt funding as well as equity funding, and it's important to understand who those providers are, and also that those providers can be fairly competitive if you actually make them compete for the funding. Thank you very much.